So last time we got started a little bit in chapter 1. We're going to be continuing our work with chapter 1 today, as well as Thursday. I think we're a teeny bit behind at this point, and it's only the second week of the semester. So we'll probably have a few things left in chapter 1 to wrap up on the 15th. So I think we'll probably have a little bit left to tie up in chapter 1. But chapters 1 and 2 really go together. They really are very integrated and interrelated chapters. So it's really not a problem to be a touch behind at this point. You will see, though, in Wiley Plus that I've pushed back the due date for the first graded homework, and the first adaptive learning chapter quiz is not going to take place this weekend. The first adaptive learning chapter quiz will take place 18, 19, and 20 September. Some of that is also just because I want my 3 sections of Accounting 1 to be on the same schedule, and the Monday, Wednesday class is now effectively a little bit behind the Tuesday, Thursday class. So we'll talk more about adaptive learning either this week or next. But last time we started our discussion of the legal forms of business organization. And we left off, where is it? There we go. We left off at this screen, and I noted that of all the different kinds of activities that a business engages in, all those activities can be classified as either financing, investing, or operating in nature. We're going to take a little bit more of a look at these different kinds of business activities, and we're going to envision the life cycle of a business. I'll lay out a little bit of an illustration of the life cycle of a business, and we'll refer to these topics over regularly throughout the semester. Right. Now, last time we were talking about the different forms of business organization, and I noted that in the Kimmel textbook, our focus is on the corporate form. So all of the businesses that we're going to be discussing throughout the semester, all the examples that you'll read in the textbook, all the businesses that we'll do problem solving for, we're going to be under the assumption that the business is organized as a corporation. But it is worth noting that there are 2 kinds of corporations. Right, before we start this discussion, there are public corporations and there are private corporations. Right? Public corporations are often referred to as publicly traded. And when we say publicly traded, we mean that you can buy the increments of ownership, the shares of ownership of publicly traded companies. You can buy those increments of ownership over the counter on the national stock markets, right? The NASDAQ, the Amex, the New York Stock Exchange. Right? Private corporations are not traded on the national stock markets. Right? Private corporations do have increments of ownership, just like publicly traded companies do. But those shares, the shares of ownership, are not bought and sold in the public markets. They're only privately exchanged between individuals. They're not brokered by a market. We often refer to private corporations as being closely held closely held. Right? There aren't very many publicly traded companies. Right? All in all, in the US, there's roughly 5-ish million corporations. Right? Much, much smaller number than the 20-ish million proprietorships. But of those roughly 5 million corporations, very, very few are publicly traded, less than 5,000, in fact. Right? Most corporations are not publicly traded. Most corporations are private, closely held, and quite honestly, private corporations are, from a functional standpoint, they're much more like partnerships than they are like corporations. Right? They're really, in most cases, glorified partnerships that have incorporated for whatever reason. Right? We were talking last time about the separation between the owners of a corporation and the corporation itself. Right? We often describe one of the characteristics of a corporation as a separation of ownership and management. And by management, we mean the people that run the corporation on a day-to-day basis. Right? In a big publicly traded company like IBM, the overwhelming majority of shareholders do not work for IBM. Right? They're separate. There's a separation between ownership and management. That is usually not true when it comes to a private corporation. With a private corporation, the shareholders, the owners of that company, are also probably employees of the company. So they're working on a day-to-day basis in the corporation. In fact, they may be the only employees. There are many, many small corporations that don't have any salaried employees other than the shareholders. Right? A corporation can have one owner, it can have billions of owners, but most of them are private and have only a handful of owners. So some of the things that we will be discussing as we move through the semester are definitely oriented towards the big publicly traded corporations, the Microsofts and the IBMs and the Intels and the Ford Motor Corporations. A lot of accounting for private corporations is very, very similar to the accounting for publicly traded companies, but there are some differences. And certainly some of the things that we're going to be talking about today when it comes to financing activities are very, very different when it comes to a public corporation as opposed to a private corporation. So I'll point that out as we move through this example. But ultimately, everything that a business does can be classified, at least from an accounting standpoint, can be classified as either a financing activity, a financing transaction, an investing transaction, or an operating transaction. Right? And of course, the starting point in the life cycle of a corporation is the incorporation process. All right, the incorporation process.
Say that again.
The starting point for the life cycle of a company is the incorporation process. Right? Before a corporation can start to do business as a corporation, they have to incorporate. Right? It's a regulatory and administrative process. All right? It happens at the state level. Right? Most of the law in this country is state law. Right? We are 50 states. We're not a federal republic like France. Right? We're a republic of individual states. So there is no federal corporate law. There's not one national law for corporations. There's state law. And the laws relating to corporations in the state of Maryland is a little bit different than the laws relating to corporations and in the incorporation process in the state of Delaware, right? Or Florida, or Alaska, or any of the states. Right? So it's important to know from a factual standpoint that you incorporate in a state, in a single state. And that does not have to be the state in which you're physically located. Right? A lot of corporations are incorporated in Delaware. Delaware is a very, very popular state for incorporation. But many of those corporations that incorporate in the state of Delaware are not physically located in Delaware. They're physically located somewhere else. Right? You can incorporate in any one state. You can do business in any state, but you can only be incorporated in one state. Right? And when you incorporate, you have to follow the corporate laws of that particular state. And one of the very first things that a new corporation has to do, one of its primary documents that's created during the incorporation process, are called Articles of Incorporation and Bylaws. And the Articles of Incorporation and Bylaws for a company are a lot like the Constitution. Right? When a corporation incorporates, it puts together laws, rules, and procedures. And those rules and procedures govern the way the corporation interacts with its owners and with other parties. Governs the way the corporation interacts with the state that it incorporates in. It governs the way the corporation interacts with a state where it does business. It governs the way the corporation interacts with its suppliers, with its creditors. Right? So the incorporation process is very important because once the corporation's articles of incorporation and its bylaws have been accepted and approved by the state, it's pretty hard to change them. And those articles of incorporation are going to regulate the way the corporation acts moving forward. So it's not a process that should be taken lightly, and it's somewhat time consuming. Right? Attorneys are almost always involved. It's always a good idea for a new corporation to have legal counsel during the incorporation process, because you have to make sure that your articles of incorporation comply with state law and don't violate any laws. And during the incorporation process, you actually have to identify your initial owners. Right? It's costs some money too. State of Delaware makes a tidy sum in fees relating to the incorporation process. But part of the incorporation process, you have to identify your initial owners. You have to give the state of incorporation the name an address and telephone number and tax ID number of the initial shareholders. Right? You have to designate your corporate legal counsel. Right? You have to designate a lot of individuals that will interact with the state of incorporation. So it's a somewhat complex process. It's interesting to note, though, that the state of incorporation, when it comes to whatever business the corporation's going to be engaging in, the state doesn't really care too much about that. You have to tell the state of incorporation what kind of business you're going to be, because there's different classes of businesses at the state level. But you don't have to give the state a business plan. You don't have to show any financial statements to the state at incorporation, because there probably aren't any to show. There may be if you were a partnership prior to incorporation, but it may be a new corporation that's never done a day of business. So it's an administrative process. But the first of the kinds of business activities that a corporation will engage in is identified during the incorporation process. Because during the incorporation process, you have to identify your initial owners. And identifying owners and engaging in financing transactions is the first activities, the first accounting and business activities that a new business will engage in. In the life cycle of a business, there is an answer to it, to the question of which came first, the chicken or the egg. Financing activities come first. There's an old saying in English, in the English language, that it takes money to make money. And that is absolutely true. Before a new corporation can do anything else, it needs to secure financing capital, or as many people call it, venture capital. All right, that's going to be among the very, very first activities that a new business is going to engage in. Financing activities, sourcing their initial venture capital. And there are two sources, one of which is identified in the organization process, in the incorporation process. And because during the incorporation process, a corporation identifies its initial owners. They have to actually tell the state how much each initial owner is contributing to the company. So over the life of a business, businesses engage in contractual relationships. And financing activities are among the very, very first contractual relationships that a new corporation will enter into. Right? And we're going to be talking all semester about transactions. Transactions result from contracts. When it comes to accounting, everything that a business does from an accounting standpoint is a contract. Every transaction that the business engages in, whether it's financing, investing, or operating, every activity is a contract. And contracts always involve both legal rights as well as legal obligations. Let me even put the word legal in here. legal rights, and legal obligations. What the company gets from engaging in the contract and what it's going to have to do as a result of the contract. Right? Legal rights are often referred to as legal benefits. Right? There's two sides to every contract. Every contract involves rights and obligations, benefits and obligations. What you get and what you have to do. And often what you have to do is something that you have to do in the future. The legal right or the legal benefit may be a future benefit. Right? It may be a current one, just depends on the particular situation. But everything that we discuss all semester long is going to be a contract. It's going to involve legal rights and legal obligations. Personally, I think everything in life is a contract, but that's no surprise. My first practice area as an attorney was public contract law. These rights and obligations are not necessarily equal. Usually they are, often they are, but they don't have to be equal. You can have a contract that has much more obligation to it than benefit, and vice versa. But every contract's going to involve rights and obligations. Every contract's going to involve parties. Who is benefiting? Who is getting obligated? Right? And as we move through the semester, we're going to be thinking about these contractual relationships from the perspective of the business. One of the parties to the contract is going to be the business. Because as we discussed last time, corporations are legal entities. Corporations can enter into contractual relationships freely and in a binding way. Corporations can own property. Right? So one of the two sources of financing capital or venture capital is identified during the incorporation process. Because during the incorporation process, the new corporation sells ownership interest to owners. Right? And remember, owners are often referred to as shareholders. Right? That's the first contractual relationship that most new corporations will enter into. This contract between the corporation and its owners. All right, so let's think a little bit about this because this is a very important legal relationship. Let's think about this from the perspective of the corporation. All right, new corporation enters into a contract with owners. The legal right that the corporation gets as a result of entering into this contract is cash. It's initial financing capital, venture capital. Right? That's the initial legal benefit that the corporation acquires. All right, this contract is governed spelled that wrong. Governed by something called Corporation and association law. At least in the state of Maryland, that's what it's called. In the state of Maryland, one of the titles to the Maryland Annotated Code is called Corporation and Association. Corporations and associations. And I spelled association wrong. I don't claim to be the world's best speller. That's better. Corporations and association law. Okay. It's part of the Maryland law. It governs the interaction between the corporation and its owners. Now we're thinking about this contract from the perspective of the corporation. So what does the corporation get? Cash. That's the benefit that the corporation gets, because it's going to need that cash. In order to engage in business activities, it's going to need cash. And because of that relationship, it has obligations as well. Now, this may surprise some of you, but when it comes to the obligations that a corporation owes to its owners, not much. And I would definitely view this contract as a very one-sided contract. The corporation gets a heck of a lot more than it has to give to the shareholders. Now, before we go any further, I do want to mention that the obligations that a private corporation owes to its shareholders are a little bit more meaningful than the obligations that a big publicly traded company owes to its shareholders. When I say that the obligations that a corporation owes to its shareholders are not much, I'm thinking about this in terms of the big publicly traded companies. Right? It is a little bit different when it comes to the private corporation. But certainly in the case of the public corporation, the benefits that the corporation gets are much more meaningful and much more substantial than the obligations that it has to discharge in the future. All right? Now I'm going to throw this question out there and see if anybody wants to venture a guess. What do you think a corporation owes to its shareholders? Anybody want to hazard a guess? Anybody want to be brave?
Dividends?
I'm glad somebody was brave enough to say dividends. All right, dividends. Dividends is just a fancy way of saying profit sharing. Dividends, profit sharing. That is actually not an obligation that a corporation owes to its shareholders. Neither are retained earnings. All right, retained earnings is just the result of activity. All right. A corporation is not legally obligated to share profit with its owners. It might, if it wants to.
Is it that the companies have to act in the best interest of the corporation? A fiduciary duty, is that what it's called?
That is an obligation, and you're right, it's technically called a fiduciary duty, but it's a very, very hard obligation to prove that the corporation violated. Unless there's outright fraud, which is relatively rare in the corporate world, unless there's very, very obvious fraud, it is extremely difficult for shareholders to prove that a corporation breached its fiduciary duty. Every now and again, you'll see a lawsuit that alleges that, but it's very, very hard for the shareholder to win because it's just very, very difficult to prove. And the mere fact that a company loses money, that it's not profitable, that is not a breach of the fiduciary duty that the company owes to its shareholders, right? Because there's no guarantees in life. There's no guarantee that the company's going to be profitable, right? So that is an obligation, but it's a pretty minor one, and corporations don't worry too much about it because it's very, very difficult for the shareholders to prove that there was a breach, right? So a corporation doesn't, it does, but it's not a really big deal, the duty of fiduciary responsibility. They definitely do not owe profit sharing. They do not ever have to pay dividends, right? And just as an example, you can be a fantastically successful corporation and not pay dividends, right? For most of its early years in organization, Microsoft never paid a dividend. Microsoft was founded in 1975, went public in 1986. It's one of the most successful corporations in history. It's one of only 4 corporations with trillion-dollar capitalization. They did not pay their first dividend until 2003, right? Almost 20 years after they went public. And they were very, very successful for those first 20 years. At the time Microsoft declared its first dividend, they had over $40 billion in liquid assets, cash and investments. And their dividend, their first dividend, was only $870 million. Most of that went to Bill Gates. So even though they were super, super successful, for most of their history, they never paid dividends, right? Now, you do have to provide information to shareholders, right? That is an obligation, but it's not a very onerous one. It's not very difficult for a corporation to discharge that obligation. And it's not very meaningful to the shareholder, right? The most important obligation, theoretically, that there's a question about dividends. Should they be paid yearly? Maybe, maybe not. It's entirely up to the corporate management as to whether dividends will be paid or not paid. There's no law that says the corporation must pay a dividend. There's no law that says how often dividends have to be paid. Some corporations pay dividends pretty regularly. IBM pays a quarterly dividend. It's not very big though, 10 cents a share. I can take my quarterly dividend from IBM and maybe get a cup of coffee at Starbucks. Depends on which size I want to buy, right? So there's no obligation to pay dividends, right? Some corporations pay them because they do want to reward their shareholders. They think that paying dividends on a regular basis will help boost their stock price. But many corporations keep all their profit so that they can reinvest in the business to grow. Okay? So what obligations do a corporation owe to its shareholders? And in my opinion, when it comes down to it, with respect to a publicly traded company, There's really only two obligations that theoretically matter to a shareholder, and they really don't matter. That's why I said that the obligations are not much. They're not meaningful, right? The biggest obligation that a publicly traded company owes to its shareholders is the right to permit those owners to indirectly run the business. Right? Now, I use the word indirectly purposefully. Right? I mentioned last time that I do have a few shares of IBM stock. I am an owner, a very, very small owner of IBM. I have no legal right to a job at IBM. IBM is not obligated to make me an employee of the company. But they do have to let me indirectly run the business. And they let me indirectly run the business the same way that the voters of the state of Maryland indirectly run the state of Maryland, right? Because those of us that are able to vote, we indirectly run the state of Maryland. Right? Now, some of you are undoubtedly voters. How do you indirectly run the state of Maryland?
We influence elections
How do you influence elections?
by voting.
By voting. And that's exactly what the big publicly traded companies have to permit the shareholders to do. Right? Shareholders indirectly run the business by voting for the board of directors. It's somewhat similar to the Electoral College. Those of you that remember your high school civics, right? In a presidential election, we don't actually directly vote for the president. We vote for electors. And then those electors in turn elect the president. It's very, very similar in the case of publicly traded companies. Every year, the shareholders of a publicly traded company get the equivalent of an absentee ballot in the mail. It's called a proxy or a proxy statement. And it's basically an absentee ballot. Right? You vote as a corporate shareholder in IBM or any other publicly traded company. You vote for a board of directors. Right? You vote for a board of directors. Right? A very, very good question about why someone would want to invest in a company if dividends are not legally mandated. And we are going to get there very shortly, right? Because you don't buy corporate stock to be able to vote for the board of directors. Theoretically, that is the most important legal right of a shareholder. And please keep in mind, there's always two parties to a contract. So one party's legal obligation is another party's legal right. Right? So I am legally entitled to vote for the board of directors of IBM. And then that board turns around and hires the CEO and the CFO and all the other senior officers. And then those officers hire all of the vice presidents, et cetera. Right? You don't buy stock in a corporation for that. Because in a big publicly traded company, your vote is really not very meaningful. Anybody remember from last week approximately how many increments of ownership IBM has right now? I'm pretty sure I mentioned that last time. Anybody remember? Right now, IBM has over 1 billion increments of ownership. My votes for the board of directors, plural, is a drop in the bucket. Unless you have lots and lots and lots of IBM stock, it's very, very difficult to influence board elections. If you're a very, very large shareholder, your word might carry weight with IBM. But for the average shareholder, that's not the case. It's even worse if you own your stock through a mutual fund, because then you don't even have a proxy to vote. The fund manager is voting proxies because it's the fund that owns the stock. Most IBM stock is held by what we call institutional investors, mutual funds and pension funds. Right. One vote or a handful of votes out of 1 billion is not very meaningful. I certainly cannot impact the day-to-day business of IBM in any way. I can't call up IBM and say, do this or do that. I can't impact IBM. So even though this is an obligation that IBM owes to me, and from my perspective, it's a legal right, it doesn't mean much. The other big theoretical obligation is even more worthless. Theoretically, the other big legal obligation that a corporation owes to its shareholders is to return what are called residual assets to the owners in liquidation. Right? So liquidation is just a fancy way of saying if the company goes out of business. All right, what has to happen when a company goes out of business, when a corporation goes out of business? Right? When any business goes out of business, the first thing that they have to do is they have to pay off all their debts. So they have to take all their assets, pay off all their debts. And then if there's anything left over, those assets are called residual assets. So it's the assets that are left over in liquidation, going out of business, once all the debts of the corporation have been paid. Right?
Professor.
Uh-huh.
So in the event that that happens, right? Let's say you're a minority shareholder.
Mhm.
There's a possibility that you won't get anything at all, right?
You will probably not get anything at all. Because here's the question that I'm going to ask you. Have you ever heard of a business, certainly a big publicly traded business, but even smaller businesses, have you ever heard of them going out of business because they've just made so much money that they're tired of making money? Have you ever heard of that happening?
No,
No. Why do businesses go out of business?
there's no longer money coming in.
They're
Or
bankrupt.
the new.
They're out of money. They are what we call insolvent. And insolvency is a way of saying that you have more debt than assets. Specifically, that you're unable to pay your debt as they come due. Right? So businesses liquidate not because they're fantastically successful, but because they've failed. And if they've failed, if they're insolvent, they have more debt than assets. And they don't even have enough money to pay off all their debt in liquidation. And if there's not enough money to pay off all their debt, then there's nothing left to give back to the shareholders. right? It is theoretically possible for a corporation to voluntarily liquidate, but that usually doesn't happen with the big publicly traded companies. Now, again, small corporations that are glorified partnerships, right? They will sometimes voluntarily liquidate, right? I think back to my grandparents, right? My grandparents were farmers, and then they basically lost most all of their farm during the Depression. And my grandfather went into the mercantile trades, right? And he sold things, right? And eventually he opened up his own business, and it was a small business, and it voluntarily liquidated. When my grandpa got too old to run the business, he liquidated because neither of his children were interested in taking over the business. So he liquidated the business and sold out. And, you know, it was a small business. He was slightly profitable. But most of the time, businesses liquidate because of bankruptcy. And in bankruptcy, creditors don't even get paid all the money that they're owed. Shareholders get nothing in bankruptcy liquidation. So this is certainly not a meaningful legal right for a shareholder, right? Now, again, there are some other obligations that a corporation owes to its shareholders. Providing annual financial information is one of them, but that doesn't have any real monetary value. So it's not a very significant obligation when it comes to from the perspective of the corporation. So this is all to illustrate what I said at the very, very beginning of this discussion, that the contract between a corporation and its shareholders is a very one-sided corporation, right? The contract, the relationship in accounting is called equity. And equity is just the accounting way of saying ownership interest. Right? Equity is the interest of owners, the contractual interest of owners. And that's a very, very one-sided contract because the corporation gets much more than it has to give. And I would say that the corporation, the publicly traded corporation, gives very little. Now, in a private corporation, the right to run the business is not an indirect right. It's a direct right. Because in a private corporation with only a handful of shareholders, those shareholders probably are also employees of the company. They may be the only employees of the company. And they are running the day-to-day business, right? So in a small corporation, this really is meaningful because in a small corporation, in a private corporation, if you're one of two shareholders, you're your own boss and you get to run your business. You have to obviously share control with the other shareholders, but you're probably working in the business on a day-to-day basis. So in the private corporation, that right to run the business is a more direct right. And that is much more meaningful. That's the reason why a lot of people go into business for themselves, is because they want to be their own boss, right? But when it comes to the big publicly traded companies, this is a very one-way relationship, one way in the favor of the corporation. But I didn't buy stock in IBM to be able to vote for the board of directors. Most of the time when I vote my proxy, I don't even know who the hell I'm voting for. I vote for the slate of directors that's recommended by the company because I don't know who any of those people are. I certainly didn't buy stock in IBM to hope that IBM would liquidate someday and that I would get my investment back. When you buy stock in a corporation, you have no expectation of ever getting your cash back from the company. And you really shouldn't buy a stock in the hope of getting dividends, because dividends are always voluntary on the part of the company. Shareholders can never force a corporation to pay dividends. So why do you buy stock? If voting doesn't matter, if you're never going to get your money back directly from the corporation, and if you can't depend on profit sharing, why would anybody want to buy IBM stock?
Because the stock price changes based on how well the company is doing. So
There you go. Absolutely. You buy stock in the hope that the price goes up, right? You buy stock in the hope that the company is successful, and then in the future, the price goes up. So the last time I checked, IBM was trading at about $130 a share. I don't keep an eye on it every single day, but let's just say you bought a share of IBM stock at $130, and 20 years later, you sold it for $200. You've made a profit, and that profit is special. That $70 profit is called a capital gain. And capital gains are special. And this is why investors invest. Because under our tax laws, capital gains receive preferential tax treatment. Preferential tax treatment. And what is that preferential tax treatment? A lower tax rate. Capital gains are always taxed at a lower tax rate than the tax rate on salary. So if you're paying taxes on your salary at, let's say, 24%, your capital gains tax rate is only going to be 15%, maybe 10%, depending on what your tax return looks like. The top capital gains tax rate is 20%. The top tax rate, individual tax rate on salaries, is just shy of 40%, 39.5%. So there's incentive in our tax code for people to invest in the stock market. Because if the stock goes up, the profit is going to be taxed at a much lower tax rate than earned income. And this is done purposefully. Is there any guarantee that the stock's going to go up in price? Any guarantees in life?
No.
No. So we have to compensate people for the risk involved in investing, because stocks don't always go up in price. IBM is off significantly from where it was a few years ago. That's not a surprise given what's happened to the economy over the last few months. But IBM stock is not trading as well as it was previously, and it could take quite a while for it to come back to where it was. There is risk in investing. The payoff is this preferential tax treatment to capital gains. Nobody buys corporate stock for either of these two reasons. Again, obligations from the part of IBM, legal rights from the perspective of the owner. Right? We buy hoping that the stock will go up in price. And over the long term, that's usually true. If you hold stock for 20 years, it usually goes up, but not always. No guarantees. Right? And if it doesn't go up enough over those 20 years, if it doesn't keep up with inflation, then you're effectively losing money anyways. Right? So selling ownership interest to owners in exchange for cash is one of the two sources of financing capital. Right? Now, sell honestly is probably not the best word to use. It's the word that is used most often, but it's really not a great word to use because sell connotes the sale of something physical and tangible, like an item, like inventory. It's really not a sale in the classical sense of a sale. It's really better to describe this relationship as an exchange. The corporation exchanges ownership for cash. And it's, again, a very one-sided exchange. Right? But exchanging ownership interest for cash is not the only source of financing capital. In fact, it's the smaller of the sources of financing capital, because corporations tend to get much more of their financing capital by borrowing money from the bank. Certainly over the lifetime of a, man, I don't claim to be the best speller or the best typist. Over the life of a corporation, the corporation's definitely going to acquire more financing capital from borrowing than from exchanging ownership interest. Right? Borrowing money from the bank creates a different kind of contractual relationship, and it's governed by a different part of the legal code. Right? This is governed by what we call debtor-creditor law. Debtor-creditor law. Different part of the Maryland legal code. All right. Now, from the corporation standpoint, the benefit, the legal benefit of entering into this contractual relationship is the same: more cash. And over the lifespan of the corporation's going to borrow much, much more money than it will receive from selling stock. That's overwhelmingly true when it comes to the big corporations. But just as the law that governs this contract is different, the obligations are very different. And there are two very important obligations that come with borrowing money. And I know some of you are familiar with those two obligations. Anybody want to help us out? What are the two obligations associated with borrowing money?
I mean, credit is one of them, and what's the
What,
other?
what do you mean by credit?
You have to have a good credit history. You have to,
Well, that's maybe necessary in order to get the loan, but that's not an obligation.
collateral.
That's not an obligation either necessarily. Those are things those are things you might have to have in order to get the loan, but they're not obligations that you're going to have to do as a result of the loan. So we have, someone has typed in interest. Interest is one of the obligations that's owed when you borrow money. What's the other important promise that a borrower, a debtor, makes when they borrow money from a lender, a creditor? It's so obvious, you're just not thinking about it. Borrow. What do you have to do when you borrow something? Pay it back, right? The two important promises. Obligations, really just a fancy way of saying promise, right? When you borrow money from the bank, you promise to return the money borrowed. And you promise to return that money borrowed at a definite day in the future, at a definite future date. It's not a promise where, oh, pay me back whenever. Now, you got to pay it back on a very particular date, a defined, definite future date. And you have to pay interest. And in accounting, we often add the word periodic interest. Because do you pay interest just once? The answer is no. You pay interest at least every year. If you borrow money on a 10-year note, you're going to pay interest every year until you pay that money back. You'll pay interest until you return the principal. Right? So the word that we use in accounting is periodic. Periodic, and that just means that every accounting period, the business has to recognize that interest, has to record that interest, right? These are very, very different promises than the promises that the corporation makes to its shareholders, because these promises have weight. They are meaningful. Because if a company doesn't pay interest when it's due, and if it doesn't pay back the money borrowed when it's due, there are very severe consequences. These promises are legally mandatory, and they have to be satisfied by the borrower, by the debtor, regardless of whether or not there's profit. When you borrow money from the bank, you don't promise to pay the bank back if you make a profit. You have to pay the bank back, period. And if you do not, bankruptcy. Creditors of a corporation can actually force the corporation into bankruptcy. If you're a borrower, a corporate borrower, and you don't pay interest on your debt when it comes due, your creditors can actually band together and force you into involuntary bankruptcy. And in the bankruptcy process, as I mentioned previously, in the liquidation process, and bankruptcy is just a forced liquidation. In bankruptcy, you have to pay off all your debts to the ability that you can pay. So during the bankruptcy process, if you had put up any collateral on that borrowing, that collateral is gone because that collateral was pledged to guarantee the loan. And since you have failed to pay the loan, bye-bye collateral. But the collateral may not even be enough to pay the entire loan off. In bankruptcy, in corporate bankruptcy, if it's a liquidation bankruptcy, there's probably not going to be enough assets, enough cash to pay off all the debt, let alone to have any to give back to the shareholders. There probably won't be residual assets in bankruptcy. These obligations are much, much more important to the corporation than these obligations. We often say that shareholders stand at the end of the line. Their interests come second to the interest of the creditors. Creditors come first. This contractual relationship in accounting is called debt or liabilities. Right? The relationship between the corporation and its owners is called equity. The relationship between the corporation and its creditors is called debt or liability. But these contracts are not the same. This is a much more important contractual relationship. And ultimately, it is typically a much greater part of the financing transactions that go on in the life of a company. Now, there was a question about leverage. Leverage is just a term that is used in finance and accounting to refer to the relative balance between a company's assets and a company's liabilities. Right? So companies that have much more debt than others are referred to as being more highly leveraged. Right? So that's really more of a finance term than an accounting term. It's a way of analyzing the financial structure of a business. Right? Now, in the life cycle of a business, financing activities and financing transactions are most numerous at startup. Because once you incorporate, you've got nothing. And you have to amass a lot of cash, right? Because you start with nothing and you need some cash. You need a good bit of cash, right? They taper off. Financing activities do become less frequent and less numerous as the company gets older, but they don't taper off down to zero. They will continue at a lower level throughout the life of the corporation because paying interest every year on your debts or every month or every quarter, however often it has to be paid. Paying interest, that's a financing activity. Eventually, you'll pay back the money borrowed. That's a financing activity. Here's a vocabulary word for you. We have a special word that means the money borrowed in a borrowing transaction. Starts with a P. Anybody familiar with the special vocabulary word for the money borrowed? Starts with a P.
Is it principal?
Principal. Principal. P-A-L, not P-L-E. Principal. That's just our fancy word for the money borrowed. Right? So you'll always hear about principal and interest. P and I. P&I, principal and interest. Right? Eventually, you'll borrow more money, financing transaction. Right? Maybe in the future, the company will issue more stock and take on more owners, financing transaction. Maybe the company does pay dividends. If the company does pay dividends, that's a financing activity or a financing transaction. But they are most numerous at startup because you go from having nothing to needing a lot of cash. And then you have to take that cash and invest it. Now, when Kimmel uses the term investing in chapter 1, he's not using the term investing the way you and I typically think of investing. Right? You and I typically think of investing in terms of speculation. Right? And that's what you do when you buy stock. You are gambling. Speculation is a fancy word for gamble. Right? You're going to gamble that the corporation's going to be profitable and that the stock price is going to go up. Right? That's how most individuals use the word investing. Taking extra cash and using it to buy stock in the stock market. Right? That is not how Kimmel is using the term in chapter 1. In terms of the 3 kinds of business activities, investing is taking that cash and using it to buy durable resources. Stuff. You got to buy stuff. Because right now, this new corporation, whatever it is, it's early in its life cycle, and all it has is some cash. It has some owners, it has some creditors, and it has some cash. It's not ready to start engaging in business activities because it doesn't have any stuff yet. It needs to take some of that cash and use some of that cash to buy some land and to put on that land a building. So they got to build a building on the land. And then inside the building, they need to put equipment and furniture and fixtures. Because you can't engage in business activities without durable resources. And I think about a business like Safeway, right? You got to have buildings, got to have Safeway stores, right? The building has to sit on land. Inside the building, you need to put cash registers and computers and scales, and you need to have shelving to hold all your inventory, right? These durable resources in accounting, we call them plant assets. Plant assets. And plant assets all have some common characteristics, starting with a long lifespan. Plant assets last for a long time. And long in accounting means more than one accounting period. More than one accounting period. Buildings, they might last 40, 50 years or more. Equipment might last 3, 4, 5, 6 years. The shelves in Safeway, they could last a good long time. So these things all have a long lifespan. They have physical substance. Plant assets have physical substance. You can touch them. and you have to have them to engage in your day-to-day business activities. Now, you can't be Safeway without a building. Even if you're selling exclusively online, you got to have a building somewhere to house your inventory. Even an online retailer like Amazon's got lots and lots of buildings and lots of land and lots of equipment. All right. So tangible substance, long lifespan, and essential to engaging in business activities, the day-to-day activities of the business. That's how Kimmel uses the term investing, right? Not speculating on the stock market with excess cash. Although businesses do that too sometimes, right? Not the small ones though. Like financing activities, these investing activities are most numerous at startup. Because again, you go from having nothing to needing everything. It's one of the reasons why so many small businesses fail. Because, you know, if you're a restaurant, for instance, you go from having nothing to needing everything before you can even open up your doors. So you're taking on a tremendous amount of debt before you even know if you're going to be successful. Right. Like financing activities, investing activities taper off after startup, but they don't go down to zero. Buildings last for a long time, but they don't last forever. Eventually, you'll need to replace your building, or you'll need to replace equipment. So you'll throw the old equipment away or scrap it, and you'll buy new investing activities. Right? So they'll taper off, but down to a lower level. At this point, once you've engaged in first investing activities, and then first in financing activities, and then in investing activities, you'll finally be able to start engaging in operating activities. And operating activities, those are the things that you do day in and day out on a regular, recurring, ordinary, normal basis. These are the things that you do because this is why you went into business, right? So think about a business like Safeway. Why is Safeway in business? What does Safeway want to happen in the normal day-to-day course of business to be successful? They want to sell. They want to sell products. Absolutely. Right? They want to receive cash from customers. In exchange for selling. Right? In exchange, selling product, selling inventory. Right? This is what Safeway does day in and day out. They sell goods. And they hope to have an inflow of cash from selling inventory, from selling groceries. That's their whole point in being. What else is going to happen on a day-to-day basis in a business like Safeway or any other company? What are other normal, regular, recurring aspects of engaging in operating activities? How do you get the inventory that you sell? How do you get the inventory that you sell? Got to buy it. All right, Safeway doesn't make anything themselves. They got to buy it. They got to buy their inventory. Safeway is what we call a merchant. They buy things, they buy their inventory from the manufacturer that makes it, and then they turn around and sell it to you and me. So they got to buy inventory. All right, what else happens on a day-to-day basis in a business? Got to pay salaries. It's a big deal for a business like Safeway. They got a lot of employees. They got to pay salaries. What else? Marketing, advertising, pay for advertising. Pay for advertising. Got to pay rent. If you don't own your building, you might have to pay rent to rent the building. What about the T word? Is that a normal part of life as a business? The T word? I know you know what T word I'm talking about. Pay your taxes. Absolutely. Death and taxes are the two things that are guaranteed in life. All right. And a lot of things listed under outflows. Only one thing listed on inflows, because there's only one thing that Safeway does to generate an inflow of cash. But they have a lot of outflows of cash. That's going to be true of any business. These are the things, we call them operating activities. These are the things that take place on a normal, regular, recurring, ongoing basis in a business. They're the result of the normal day-to-day activities of a business. Safeway may pay rent, probably not on their stores. They probably own all their store buildings, but they may have some equipment that they're leasing in their buildings. And a lease is just a fancy kind of rental agreement. But a lot of smaller businesses may not own the building that they occupy. So many businesses probably do pay rent. And the outflow list could be much longer. We could keep that outflow list going for a long time. But these things happen on the normal, regular, recurring, ordinary basis, day in and day out, day after day after day. In accounting, we refer to the inflows as revenues and the outflows as expenses, right? The inflows of cash related to the normal day-to-day business activities are called revenues, and the outflows of cash as a result of the day-to-day business activities are called expenses. And here is something that's a key to understand. And you know that at startup, operating activities are zero, and then they hopefully increase. But ultimately, for long-term success, a business has to be able to generate what we call operating capital. All right, we talked about financing capital or venture capital. That's the money that comes from selling ownership interest to owners or borrowing money from the bank, the result of financing activities. Operating capital is the excess of revenues over expenses. And for long-term success, for a long life, you have to generate operating capital because there is only so much money you can borrow. Eventually, any business, no matter how successful, they can only borrow so much money because the banks will only lend so much. There's a limit to how much you can borrow. There's a limit to how much stock you can sell. It's a simple supply and demand relationship. The more shares of IBM stock that are out there in the market, the lower the market value of the stock is going to be. Eventually, the value of your stock will be very minimal, and no one will want to buy it. For long-term success, you have to generate operating capital. You have to be profitable because of what you do on a day-to-day basis. Your operating profit not only has to pay for all the inventory that you buy and all the salaries and wages that you pay, it has to be enough to pay interest on your debt. Because you can't borrow from bank number 2 to pay bank number 1. It doesn't work that way. For long-term success, you have to be profitable from operations. And to be profitable from operations often requires growth and expansion. Think of a restaurant, right? There are only so many tables in a restaurant. A restaurant can only seat so many diners per evening in a normal world where you can actually go out and sit down in a restaurant. But ultimately, there's only so much revenue that a restaurant can generate in one location. Operating activities start at 0, they increase, but they level out because you reach capacity. And once you reach capacity, the only way that those operating activities can increase anymore is to expand. That's another reason why a lot of corporations don't pay dividends, because they need all their excess operating capital in order to grow and expand. Ultimately, for long-term survival, you have to be operationally successful. That's something important to keep in mind. So operating activities behave almost exactly the opposite of investing and financing activities. Investing and financing activities are most numerous at startup and then they taper off. Operating activities, on the other hand, start at 0 and go up, and hopefully they level out at a higher level or continue to increase in a stair-step fashion with expansion. Right. So we'll return and think about these illustrations of the 3 kinds of business activities regularly throughout the semester. We'll often think about the life cycle of a business and some of these issues. All right.
All right, Professor. See you
But
Thursday.
we're not quite done yet.
Oh, my bad.
I got a couple more words to get in before I leave you. Just a couple quick things to add, but we are close. So we are going to see this screen many times over the next couple chapters, because this little screen, this little slide here, is chapters 1 through 4. Right? At its heart, accounting, at least financial accounting, is all about communicating information about all the things that happen in a business. Right? To communicate that information, you have to process the information. You have to collect it and measure it and record it. And these are our first 4 chapters, right? Chapters 1 and 2, we're looking at the communication piece. Chapters 3 and 4, we're looking at the identification and recording piece. But ultimately, accounting is the language of business. It's about communicating information to people that are interested in knowing what's going on in a business. Right? Are people interested in knowing about what's going on at Amazon from a financial standpoint? Of course. Who is interested in knowing about the results of Amazon's business activities? What kinds of entities are interested in knowing?
Shareholders.
Shareholders want to know. Who else wants to know? Creditors definitely want to know.
The government.
The government wants to know. The Securities and Exchange Commission wants to know. The IRS wants to know. Lots of entities, lots of different kinds of people are interested in knowing what goes on in a business, particularly the publicly traded ones. Right? But even to a smaller degree, the private corporations. We can broadly classify them into 2 groups: internal users and external users. Right? Internal users are employed by the business. Right? So everyone who works at IBM is an internal user of information, of accounting information. External users are not employees. And internal and external users have very different information needs. Internal users, people that work for the business, by definition, they know a lot about what's going on a day-to-day basis in the business. Right? If you are a production supervisor at Intel Corporation, you know a heck of a lot about what goes into the manufacturing of an integrated circuit. Do you think anybody at the IRS knows anything about how to manufacture an integrated circuit? I think the answer to that semi-rhetorical question is no. Your average IRS examiner doesn't know the intricacies of manufacturing an integrated circuit. If you work on the production line at Intel, you better know your needs, what you need to know about the finances and the accounting for Intel is very, very different than what that IRS examiner needs to know or what a bank needs to know. And consequently, we have different accounting to provide internal information versus external information. The internal accounting needs of a business are satisfied by what we call managerial accounting information. You'll learn a little bit more about that in Accounting 2. ACCT 222. For many of you, you'll take it in the spring. Some of you will take it later than that. It just depends on when you get around to it. Right now, we're learning about financial accounting. Financial accounting is about providing information to external users, to people that are not employees of a business, and therefore don't know much about the day in and day out of the business. And I don't know much of anything about how to engage in cloud computing activities, but I still want to see financial information from IBM. But to understand IBM's financial information, financial accounting information, I don't need to know anything about cloud computing. I just need to know a little bit about the rules of financial accounting, because financial accounting is very rule-based. It's very standardized. It follows very, very specific rules, and the information is conveyed and communicated in very standardized and particular ways, so that anyone who has even a little bit of instruction in accounting can understand the data. Managerial accounting is much, much more customized because it needs to be tailored to a particular business. The managerial accounting that's provided at Intel is very, very different than the managerial accounting that's provided at, say, Coca-Cola. It's not rule-based the way financial accounting is, because it's very customized and tailored. All right? We're learning this semester about financial accounting, and the chief communication tool are the financial statements. The primary way that a business communicates with its external users is through the financial statements. And pretty much the first thing that we're going to do on Thursday, we're going to learn how to prepare the income statement line by line. We'll be jumping right into problem solving on Thursday. We'll also learn in Chapter 1 how to prepare the retained earnings statement. Right, as I mentioned, we're going to defer preparation of the balance sheet until Chapter 2, because I don't really like what Kimmel does with the balance sheet in Chapter 1. But we will talk a little bit about the big picture purpose of the balance sheet and what it tells the reader. We'll do the same thing for the statement of cash flows. We'll talk about the big picture, but we will not learn how to prepare the statement of cash flows this semester. The statement of cash flows you'll learn how to prepare in Accounting 2. Right. So we will be starting with the income statement on Thursday. So until then, have a good rest of the day and a good Wednesday.
Thanks, Professor. You too.
You're
Enjoy
quite
your day.
welcome. I'm going to stop the recording, but if there's any questions, I can certainly